If you're watching this video, you're probably brand new to trading and feeling a little bit frustrated. You have tried your support and resistance lines and experimented with chart patterns like hammers, dojis, and many more. But despite all that effort, you just can't seem to win. What if I told you that the key to unlocking consistent profits lies not in these traditional methods, but in understanding how smart money operates? If you don't already know me, my name is Nick, and I'm a multi-7-figure trader with absolutely nothing to sell you. No course, no signals, nothing. I was just like you, scrolling through countless of trading videos after taking loss after loss, struggling to find out why I couldn't get it right. Fast forward 7 years. I've cracked the code. And now I get consistent monthly withdrawals like these. In this video, I'll explain the basic smart money concepts that you need to apply to the chart before taking any trade. Now this includes, number 1, identifying market direction. Number 2, understanding key patterns that point to reversals. Number 3, finding areas of interest for trading, specifically supply and demand zones. And number 4, recognizing liquidity pools. Lastly, I will give you a step-by-step explanation of the best smart money concepts trading model that every SMC trader should know. Now, this is all you need to profit. If this sounds like something you'd be interested in, smash that like button and hit the subscribe button down below. Make sure to turn on the notification so you never miss an update and you'll be alerted on our latest YouTube video just like this one. With that being said, let's dive right into it.
First things first. Why smart money concepts? In my own experience, SMC gives clear logical criteria for chart analysis other than magical boxes and lines that are meant to be holding price down. It makes understanding any price chart more systematic and can consistently spot solid trading opportunities for me. So, let's start with the basic concepts and fundamentals. Number 1, how do we identify market direction? Number 2, supply and demand zones. And number 3, who is in control, the buyers or the sellers? Identifying market direction is generally the first step in an SMC style analysis. I want you to think about it like this. If you knew that there was an 80% chance of a pair going down and a 20% chance of a pair pumping, which would you pick? When we first approach a price chart, we want to identify the trend and determine if buyers or sellers are in control. Our job as traders is to aim to trade in alignment with whichever side is in control of the market. If buyers are the majority of the market, we want to ride the wave of longs. If the sellers are dominating, then we want to catch that dump with them. So, how exactly does a SMC approach work? This approach operates on mitigations. Mitigations means to come back to a key level where buyers and sellers are exchanging hands. For example, when price mitigates a demand level, demand takes control over supply. Conversely, when price mitigates a supply zone, supply takes control over demand. A supply is an area where price should be held down because the pair is at a good price to sell. And demand is an area where price should be held up because price is at a good price to buy. Now, just imagine a Rolex. If it was priced at $1 million, it will be a good price to sell. If it was priced at $1, it would be a very good price to buy. I know it is an exaggeration of the concept, but this is what supply and demand zones essentially mean. Now let's say price is moving in an uptrend, creating a series of high highs and high lows. Every time price breaks structure to the upside, it creates inefficiencies or imbalances, like here and here. A demand zone is formed at these inefficiencies. These demand zones remain unmitigated or unchallenged until price taps into them, offering a perfect opportunity to follow the dominant trend. Basically, what it means is that these are areas where there will be a lot of limit orders placed because buyers will think that it is a good price. So once price taps into these areas, these limit orders will be filled and price will shoot up. However, If price breaks below a demand area, this is called a change of character, and it indicates two things. Number one, supply has taken control over demand. And number two, a supply zone has been established. Price then continues to move downwards, forming supply zones until it reaches the next unmitigated demand area. At this point, there is a fight between the supply and the demand, where we will often see a period of consolidation and ranging market conditions between these two zones. Whichever zone breaks indicates which side took over the market. Let's take a look at this example here. In this price leg, we move higher aggressively, and we have a break of structure with a strong candle closure above, over here. This leaves behind a strong, unmitigated demand zone over here. We have a few more moves that breaks above the previous market structure, indicating that demand is in control. As you can see, right over here, right over here, right over here, and over here. At this point, a new unmitigated demand area is created, the newly formed demand right here, which will act as our support. Still, the market sentiment is bullish as long as price trades above the extreme demand right over here, which is our original demand zone. Here's the first example of finding the trend based on demand zones and market structure. And I'll move on to the next. Now we can see that the market is failing to break the most recent high with a body candle close as seen right over here. This indicates a potential weakening in bullish momentum. Due to this lack of buying strength after breaking all these low points as seen from the candles here, we can conclude that the buyers are no longer in control and we might start to witness a reversal happen. If we consider this point as the start of our impulse move that caused the market structure shift, this area here would be our supply zone. The market continues to break to the downside, showing that the supply is in control. Along the way, we are also creating multiple supply areas like these and these. Each of these supply areas could be a potential selling opportunity until we reach this original unmitigated demand area, which we marked out earlier on. Once we are back at the original demand zone, this zone can be a potential interest area for the buyers to step back into the market. So at this point, we have a battle between the buyers and sellers. Therefore, we must wait and observe the further price action to determine the market direction. Because this level can be a turning point for price, or we might at least witness a temporary correction. Eventually, as you can see, buyers stepped in and took over, pushing through the supply zone and continuing the market's bullish intent. Here's an important point for you to take note of. We as retail traders cannot control the market. However, we can prepare ourselves for the different scenarios that might play out. Let's move on to the next topic. Smart money market structure to aid us in this preparation. Market structure holds crucial information on overall market direction, key supply and demand areas, liquidity zones, and set the stage for a potential trading opportunity. Let me show you some basic concepts about smart money market structure. In an ideal uptrend, the market continuously makes higher highs and higher lows. Every time the market breaks a structure to the upside with an imbalance or a fair value gap, a demand level is created. For those of you who are new, a fair value gap is a 3 candlestick pattern. The gap between the first candle's wicks and the third candle's wicks is the fair value gap. This is an area of fair value because there are a lot of pending orders here waiting to be filled. So we expect price to retrace into these gaps to fill and continue moving. The demand levels that create a fair value gap are super important as they are the backbone of technical analysis using SMC concepts. As long as we stay above this zone, buyers are in control and the market sentiment is bullish. However, if we get a break and close below this level here, we call this a change of character or CHoCH. This signals a potential reversal. Likewise, for the bearish scenario, if we stay below this zone, sellers are in control and the market sentiment stays bearish. However, if we get a break and close above this level here, we call that a change of character as well, signaling a bullish reversal. With that being said, the levels that create the fair value gaps and break of structures consist of key market structure points, and how price reacts at these areas gives us a lot of information on the overall market direction. Before we move on to the next section, I want to preface the rest of this video with this. Keep in mind that market structure and liquidity are two inseparable concepts in trading SMC. They go hand in hand. Liquidity, when aligned with structure, assists us in our trading accuracy, giving us extremely high probability trades as a result. With that, let's move on to the next section. Liquidity pools are where retail traders get involved in the market. From a retail trading standpoint, we know that multiple rejections at a level are considered a good entry level for traditional retail traders. Because of that, there are many stop losses set below these rejection points right over here. The banks aim to sweep or collect these stop loss orders, or liquidity as they call it, to fuel their own buy or sell positions. As SMC traders, we want to enter with the banks and enter the trade after the retail stop losses have been swept. This allows us to enter at very low drawdowns and maximize our trades. Let me show you one of the most powerful SMC concept liquidity models which combines both market structure and liquidity. The first model is a basic liquidity sweep through a major structural level. This is the Australian US dollar on the 15-minute chart. We have a clear downtrend signified by the creation of lower lows and lower highs right over here and here. We have a recent level of support turned into resistance as marked out by the grey box right over here. This area here has been rejected by the market multiple different times. When price approaches this level, retail traders will short, anticipating a further rejection from this key level. Also, traders who previously entered short positions would scale in with even more opportunities at this region. So, this area is considered a key liquidity level, as retail stop losses are gathered somewhere above this area here. Now, the question is, as a smart money trader who would look to trade with the flow of the big players in the market, where would be a good point of interest be? If we look to the left-hand side, you will notice that there is a fair value gap. As discussed earlier in the video, it is a supply zone as it is a bearish fair value gap. This is our point of interest and we can look for short opportunities. As a SMC trader, we want to get involved in the market after the stop losses have been swept. This trade right over here is a perfect example of combining market structure and liquidity concepts to get involved in a trade. As you can see, price instantly dumps the moment it taps into the fair value gap after taking out the liquidity from the smaller players. Let's see the second liquidity model. This one is a little bit more advanced, so pay close attention. Here on the Australian dollar 5-minute time frame, we can see that we have a valid bearish order block. I'll talk about this a little more later on. This would then give us a potential trade opportunity to go short. But hold on, we are not just going to short blindly right there and then. Take a look to the left side. We can spot this fair value gap between the candles right above the first order block over here. We also have another order block right above it, right here. What normally happens is this. The fair value gap will act as a magnet for price to come and fill and rebalance the market. So, smart money will grab the liquidity above the first order block and continue pushing upwards until it mitigates the second, higher order block before price continues breaking down again. Here's what you need to learn from this. Number 1, before hopping into a trade, you should look at the left side and be aware of your surroundings and other key areas of interest to avoid unnecessary bad entries, leaving you more risk exposure for no reason. Number 2, as discussed earlier, structure and liquidity go hand in hand. One cannot work optimally without the other. When you see this kind of scenario happen, a fair value gap and another value order block close to the first one, we don't consider this break higher as a valid change of character, since there is a high probability that this move is just a liquidity grab and does not necessarily mean a reversal is coming just yet. Part 4. Now that we have discussed the key concepts required for general charting and how to identify the market direction, key areas of interest, and potential trade opportunities, let me explain 2 of the best smart money trading setups step by step. Let's start with a basic order block entry. A valid order block is an optimal supply and demand area. Therefore, whenever we have sharp moves with fair value gaps present, breaking the previous market structure. How we can easily identify a valid order block is by marking out the last candle that created a fair value gap and breaks previous structure. We believe this order block will be a sensitive area in the markets, which will cause strong reactions when tapped into it. Now, back to the setup. This order block setup is extremely simple and effective. In this setup, we'll use a basic order block entry when aligned with specific market conditions. The first step is to look for a valid and unmitigated or untapped order block that the market has recently created. All we need to do is simply place a buy order at the order block zone and place our stop loss below the swing low, aiming for a static 1:2 risk to reward ratio. You could stretch your take profit more and aim for the next key level of price, but a static 1:2 RR makes this approach easy to follow and more consistent. To make this strategy even more effective, take note of the following key points. Number 1, trade with market direction. This strategy works best as a trend continuation setup always plays out when the market direction is clear and the dominant side is identified, trading with the dominant trend. This increases your chances of success and reduces the risk of getting trapped on the wrong side of the market. Number 2, check higher time frame key levels. Before trading, look out for high time frame key levels and how much room price has to play with before reaching those levels. At higher time frame levels, we expect some sort of a rejection. These rejections at higher time frame key levels can potentially cause a major direction change on the lower time frames. When price mitigates a higher time frame key level, there's a high chance of a temporary reversal. So, always check the higher time frames to gauge the current market price distance to key levels. Number 3, as we discussed in the previous section, analyze towards the left side of your chart. Now, let's take the example that I showed you earlier on. Before placing any trades, analyze the left side of the chart to avoid low probability setups. For example, if your valid order block is positioned in a key liquidity pool, or if there are fair value gaps and another order block just above or below your entry, the risk of your SL being swept increases. Now, let's move on to the second trading strategy and my absolute favorite one. This is the higher time frame order block plus lower time frame liquidity sweep strategy. I'll touch this in more detail since this is more advanced, but it's also the setup that I use every single day. We use 2 time frames to execute our trade based on this setup. Number 1, a higher time frame, 4 hour or 1 hour, and the lower time frame, the 15-minute or the 5-minute time frame. First, we analyze the market direction and structure. The goal here is to figure out whether the markets are trending upwards or downwards. Then, we mark out our higher time frame order block. Now, if you're still unsure, rewind to the order block section. Next up, we wait for price to return into the order block area. Now, once that happens, we drop down to the lower time frames and look for a change of character to confirm our entry. The key of whether this entry strategy works or not depends on your change of character. This entry will not work if you do not see a change of character. If there's no change of character, we will not take a trade. This is because a change of character indicates that the short-term pullback on a higher time frame is over and the market should start to continue to move with the overall trend. There are two common scenarios for this entry. Number one, a change of character with a fair value gap plus a lower time frame order block. Number two, a change of character without a fair value gap and a lower time frame order block. When a change of character is accompanied with a fair value gap and it creates a lower time frame order block, we can place our limit order at the start of the order block zone and set our stop loss above or below the swing point. For this specific setup, we will look to trail our stop losses by repositioning our stop loss below every new higher low in an uptrend or above every new low high in a downtrend every time the market breaks structure. This allows us to maximize profits if the market moves in our intended direction and protect us from any potential loss which can be caused by reversals. I'll show you an example later. The other likely scenario is where there's a change of character without a fair value gap or order block. When this happens, we have two ways to enter. First, you can mark out the change of character level and wait for that level to be retested for a more impulsive entry. Ideally, you should use the Fibonacci retracement tool with these settings right over here. 0, 0.79, 0.7, 0.62, 0.5, and 0 to enter the market. And where you want to enter it as at the 0.6 and the 0.79 retracement zone. We do this by anchoring the Fibonacci tool from the start to the end of the move that caused the change of character. Then we can place a limit order at the 0.62, 0.7 or the 0.9 zone with stop loss at the most recent swing point. Now, this strategy is not limited to any specific time frames. However, your entry time frame should be at least 2 times lower than your reference higher time frame. Now, let me show you 2 trade breakdowns with each scenario to show you exactly what I mean. Here we have the Australian US dollar chart on the 4-hour time frame. Now, let's start off with the first example. A change of character with a fair value gap plus a lower time frame order block. Now, let's go through our checklist step by step. Step 1. Analyze market direction and structure. Overall, we have been pretty bearish. We then have a slight pullback and created a valid bearish order block. Why is it a valid bearish order block? Because we have a sharp move with a fair value gap, breaking previous market structure. So we mark out our last candle that created the fair value gap that broke past previous structure. That candle would be this one right over here. Step 2. We wait for price to return to that order block area. And it does so right here. Step 3. Drop down to a lower time frame. In this case, I'm using the 5-minute time frame. We will look for our change of character. As you can see, the change of character forms right over here. As this change of character is forming, you can notice that there is a fair value gap forming here. This creates a lower time frame order block. So, we'll place our limit order at the start of the order block zone and set our stop loss above or below the swing high. Now, to manage this setup, we will trail our stop losses by repositioning our stop loss above every new low high every time the market breaks structure to the downside. And you can see just how effective this approach. It keeps running and it keeps netting you larger profits, allowing you to put all those gains in your bank account. Let's go through our next example. Step 1. analyze market direction and structure. Overall, price is stuck somewhat in a range. We then have a sudden huge displacement lower, and it creates a valid bearish order block along the way. So right now we have a sharp move downwards, we have created a bearish fair value gap, and we have broken previous market structure. So what we can do now is mark out the last candle that created the fair value gap and broke the previous structure. That candle will be this bullish candle right over here. Step 2, we wait for price to return to the order block area. As you can see, price taps in. Step 3, drop down to a lower time frame. Again, let's use the 5-minute time frame. We will look for our change of character, and as you can see, price has formed one right here. This change of character does not have any significant unmitigated fair value gaps. So at this point, we will use the Fibonacci retracement tool and anchor the Fib from the start to the end of the move that caused the change of character. Then, we will place a sell limit order at the 0.62, 0.7 or the 0.79 with stop loss at the most recent swing point. Now let's just use the 0.62 zone for consistency's sake. So we will place our sell limit here with stop loss at the swing high, and again trail our stop loss with each market structure break. And in this case, price just dumps all the way down to our target, which is the swing low right over here, giving us a solid trade.
That is it for this video. I hope this video brought you some value. If you want to see these concepts executed live, smash the like button for me and subscribe down below to our channel to catch me trading live every single day in front of thousands of other fellow traders. And I'll see you guys on the live streams. Nick signing out.